Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hims & Hers Health Inc. Annual Report. Hims & Hers Health Inc. offers a wide range of businesses and services to its customers. At the core of their operations is a telehealth platform that connects consumers with licensed healthcare professionals across various countries. This platform enables customers to purchase curated health and wellness products directly from the company's websites or mobile application. The company provides prescription medication on a recurring basis, along with ongoing care from healthcare providers. In addition, they offer over-the-counter drug and device products, cosmetics and supplement products that cater to general wellness, sexual health and wellness, skincare, and hair care needs. Their curated non-prescription product range includes items such as melatonin, biotin, moisturizers, condoms, and shampoos. Beyond product sales, Hims & Hers Health, Inc. also offers medical consultation and post-consultation support services. They provide labs, which measures key markers over time and offers doctor-developed action plans. Furthermore, the company partners with wholesale partners to offer health and wellness products to a broader audience. Overall, Hims & Hers Health, Inc.'s diverse range of businesses and services aims to cater to various aspects of customers' health and wellness needs. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what might cause a stock price to crash. The sudden and drastic decline of Hims & Hers Health, Inc.'s stock price in the past year is a concerning trend that warrants examination. Several factors could be contributing to this downturn. One possible reason is poor financial performance, such as declining revenue or increasing losses. This can erode investor confidence and lead to a sell-off. Another potential cause is regulatory issues or legal troubles. If the company is facing lawsuits, fines, or other regulatory challenges, it may negatively impact its stock price. Additionally, changes in market trends or shifts in consumer preferences could also be contributing factors. For instance, if the demand for men's and women's health products declines, it could lead to a decrease in sales and revenue. Furthermore, internal issues such as leadership changes, executive departures, or strategic missteps can also affect investor sentiment and stock price. If investors lose faith in the company's management team or question its ability to execute on its business plan, they may sell their shares, further exacerbating the decline. Lastly, external market factors such as economic downturns, industry-wide trends, or broader market volatility could be contributing to Hims & Hers Health, Inc.'s stock price crash. These factors can be unpredictable and outside of the company's control, making it challenging for investors to anticipate and prepare for potential declines. In conclusion, the decline of Hims & Hers Health, Inc.'s stock price in the past year is likely due to a combination of internal and external factors. To recover, the company must address these issues and demonstrate its ability to adapt to changing market conditions. Hims & Hers Health, Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Hims & Hers Health, Inc. trades at a higher price-to-earnings ratio of 29 times and a higher price-to-book ratio of 6.07 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be categorized into several key areas. Firstly, investments in new manufacturing capabilities and diversification of fulfillment partners and suppliers have contributed significantly to revenue growth. Additionally, the expansion of internal fulfillment capabilities, redistribution of prescription product sales, and onboarding of new suppliers have also played a crucial role. Furthermore, changes in customer prepayments and an increase in shipping cadences of weight loss offerings have led to a substantial increase in deferred revenue. The company's advertising costs have also seen a significant rise, with $814.9 million spent in 2025 compared to $390.3 million in 2023. Moreover, the sale of equity and issuance of convertible notes have contributed to revenue growth. On the other hand, the primary drivers of revenue decline are contingent consideration for tax loss reimbursements and unrecognized stock-based compensation related to employee stock purchase plans, ESPP. These factors have resulted in a decrease in revenue, although the impact is relatively minor compared to the overall revenue growth. The net income of a company underwent significant changes between 2023 and 2025. Initially, in 2023, the company reported a loss of $23,546. However, by 2024, this turned into a profit of $126,038. The following year, 2025, saw an increase in net income to $128,365, representing a modest growth of 1.8% from the previous year. The improvement in net income can be attributed to several factors, including revenue growth, improved operations, and reduced matching contributions cost. These positive changes contributed to the company's ability to turn its losses into profits. On the other hand, profit margins experienced a decline between 2024 and 2025. The gross profit margin decreased from 79.3% in 2024 to 74.1% in 2025, representing a drop of 5.2 percentage points. Similarly, the operating income margin increased from 4.2% in 2024 to 4.5% in 2025, but this growth was not enough to offset the decline in gross profit margins. The reasons behind the decrease in profit margins can be attributed to increasing advertising costs and impairment charges on long-lived assets. These expenses had a negative impact on the company's profitability, leading to a decline in its overall profit margins. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the annual reports, the company has consistently produced positive cash flows from operations over multiple years. Specifically, for the years ended December 31, 2025, 2024, and 2023, the company reported positive cash flows. A closer look at the financial data reveals that the net cash provided by operating activities has been steadily increasing over the years. In 2025, the company generated $300,006 in operating cash flow, a significant improvement from the $251,084 recorded in 2024 and the $73,483 reported in 2023. This upward trend is a positive indicator of the company's financial health and its ability to sustain itself over time. The consistent generation of positive operating cash flow suggests that the company has a solid foundation for growth and expansion. It also implies that the company's management team is effectively managing its resources, ensuring that it can meet its financial obligations while still investing in its future. Overall, the company's ability to generate positive operating cash flow is a key factor contributing to its long-term success. The company's debt level has undergone significant changes over the past year. Initially, it increased by $1 billion with the issuance of 0% convertible senior notes due 2030. However, this was followed by an increase in liquidity from $300.3 million to $928.8 million as of December 31, 2025. The total liabilities also saw a substantial rise from $230,823 to $1,613,777. In terms of interest expenses, there has been a notable increase due to the amortization of debt discount and issuance costs. This expense was $0 in 2024, but jumped to $4,529 in 2025. The interest rate under the credit facility also changed from unspecified to 0.1%, 2%, which may impact future interest expenses. The principal amount of the 2030 convertible notes remains steady at $1 billion, indicating no change in this specific debt obligation. Overall, while there are some fluctuations in the company's debt level and interest expenses, the changes suggest a significant increase in liabilities and interest costs over the past year. Management is optimistic about the company's growth prospects, driven by investments in infrastructure, international expansion, and strategic acquisitions. Key drivers of growth include long-term investments in fulfillment, distribution, and operating capabilities, as well as personalized solutions that are expected to increase total revenue. The company plans to continue pursuing opportunities for manufacturing and internal fulfillment capacity expansion, supported by existing cash resources. Management is also investing in risk mitigation strategies, including diversifying fulfillment partners and expanding internal fulfillment capabilities. Overall, the management's outlook is positive, with a focus on driving growth through strategic investments and mitigating risks. The company's financial projections indicate that it has sufficient cash to meet obligations for at least 1 year, and there are no conditions or events that raise substantial doubt about its ability to continue as a going concern. The company has made several significant acquisitions in recent years, expanding its portfolio and capabilities. In July 2025, it acquired Zava Global GmbH for $258 million. This was followed by the acquisition of Medici Technologies, Inc. in November 2025. The company also acquired Urbio Health, Inc. in January 2026 for a total consideration of $150 million upfront, plus potential contingent consideration. In addition to these acquisitions, the company has made other notable purchases, including the CS Bio Co. asset acquisition and business combinations with Zava and Medici. Furthermore, it is proposed to acquire Eucalyptus in February 2026 for up to $1.15 billion total consideration. Interestingly, there have been no divestitures mentioned in the summary, indicating that the company has focused on growth through acquisitions rather than shedding assets. The company's financial activities over the past period have been notable in 2 key areas. Firstly, it has chosen not to distribute any cash dividends to its shareholders. This decision suggests that the company is prioritizing other uses for its funds, such as reinvestment or debt repayment. On the other hand, the company has engaged in share buybacks, purchasing a total of 2,042,652 shares at an average price of $39.41. This move indicates that management believes the company's stock is undervalued and presents an opportunity to increase shareholder value through this strategic investment. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal a multitude of concerns regarding inventory buildup and supply chain disruption. On page 12, it is noted that there may be inventory buildup due to limited use of 503 billion outsourcing facilities and potential inability to meet customer demand, which could lead to supply chain disruption. Furthermore, on page 13, the company's limited experience with API operational areas, third-party manufacturers, and suppliers for sample collection kits and kit components raises concerns about potential disruptions. The need to evaluate and validate alternative kits if a supplier modifies or discontinues production also poses a risk. The impact of global supply chain disruption is highlighted on pages 19 and 21, where it is stated that such disruptions can affect operations and increase costs due to compliance or alternative sourcing. Additionally, the FDA's restriction on GLP-1 active pharmaceutical ingredients and HHS investigation into potential FDCA violations have contributed to elevated consumer demand for GLPs. On page 24, the ability of facilities to meet inventory and product fulfillment expectations is a concern, while page 31 notes that geopolitical tensions, tariffs, economic sanctions, and trade restrictions can lead to increased market volatility or declines. This in turn may disrupt suppliers' ability to purchase sufficient quantities of products. The risk of supplier concentration is also highlighted on page 33, where it is noted that certain products are primarily fulfilled by one supplier, which could significantly slow fulfillment if this supplier stops fulfilling orders. The storage of a significant portion of inventory in company facilities and with third-party logistics providers, page 36, also poses a risk, as damage or disruption at any facility or with any third-party logistics provider may harm the business. Regulatory changes and potential enforcement actions affecting third-party suppliers and manufacturers are also mentioned on pages 44 and 45. The concerns about supply chain disruption due to catastrophic events, system failures, or vendor/supplier disruptions, page 54, further emphasize the risks associated with inventory buildup and supply chain disruption. Finally, the financial impact of these concerns is evident in page 82, where it is noted that inventory increased by $13.7 million in 2025, contributing to a net cash outflow from operating activities. The significant increase in inventory costs, $5,843,000 in 2025 versus $5,874,000 in 2024, on page 131, also underscores the financial implications of these concerns. In conclusion, the extracted summaries reveal numerous concerns about inventory buildup and supply chain disruption, which pose significant risks to the company's operations and finances. That concludes the financial summary for Hims & Hers Health Inc. Feel free to comment below, and I will be happy to answer them when possible.